Okay, well, let's kick it off. Firstly, hello everyone, and welcome to our webinar, where today we're going to discuss our latest white paper, The Impact of Political Change on Africa's Credit Outlook in 2025, a joint initiative by Pangea Risk and Acre Impact Capital. My name is Gabby Reid. I'm Head of Advisory at Pangea Risk, and I will be your moderator for today's session. Over the next 50 minutes or so, we are going to delve into the key findings from our recent white paper, which examines how Africa's credit outlook this year is set to be influenced by significant political shifts, both globally and domestically. Obviously, changes in US leadership, evolving trade and tariff policies, combined with some key election outcomes on the continent, will shape sovereign risk, debt sustainability, and investor sentiment going forward. Now, the white paper itself includes a scenario mapping exercise to explore potential trajectories of US and Africa engagement, which I know will be a keen topic of interest today, alongside an analysis of how political transitions closer to home may affect domestic credit risk and fiscal policies. We'll be exploring these themes and a whole lot more with our esteemed panelists who were the main contributors to the report. So joining us today, we have Faisal Khan, Chief Investment Officer and founding partner at Acre Impact Capital. We are also joined by Bilal Soni, Head of Risk Forecasting at Pangea Risk, and Zainab Hassan, Senior Africa Analyst at Pangea Risk. A warm welcome to you all and a warm welcome to our audience. Before we kick off, just a note to the audience, please do submit your questions through the Q&A function on the Zoom platform. We will leave around 15 minutes towards the end of the session to address these, and do feel free to allocate any of your questions to a specific panelist. Finally, we will also share a QR code to the white paper itself at the end of the session, so please do stay online to get that code. Right, without further delay, I think it would be great if we get started. There's a lot to cover today. Faisal, I'm going to start with you. I think it's certainly been an interesting week when it comes to the global markets. Obviously, this is in light of the latest US tariffs we've seen come out of Washington last week. I think what would be really useful if you could just set the stage for us today, where are we standing right now regarding the global markets, and then look at their impact on credit spreads in Africa. What is this wave of global uncertainty doing in terms of market liquidity, investment sentiment, or even risk premiums on the continent?
Thank you very much, Gabby, and it's great to be here with my esteemed panelists and participants in this webinar. Gabby, if I can just move across to the next slide in our presentation. Yes, indeed, it has been a very interesting week. Just a week ago today, in fact, President Trump announced his latest tariffs that have since sparked off extreme volatility in the market. You can see in the chart on the bottom right-hand side how the equity markets have reacted, how the volatility index, which measures volatility in the market, touched 60 just for the fourth time in its history. Just for context, the VIX touched 90 back in the global financial crisis and 85 during COVID. So equity markets have experienced, the worst sell-off since the COVID era, February 2020, wiping out reported 10 trillion from the equity markets in a space of 3 days. And rates haven't been immune either. US Treasuries, bonds, and gilts have all sold off earlier this week and in fact, they're still selling off on fears of higher inflation, possibility of foreign holders reducing or disposing their treasury assets, and the chances of government having to provide stimulus packages to counter the impact of tariffs to economic growth. You can see in the top right slide that the commodity markets, which as we know are very important to the continent, have also suffered. Oil has gone down by about 15% over the last 1 week and touched below 60 earlier this morning. So it's been quite a hectic 1 week, primarily due to what's the announcements made last week on the second, and some of the rhetoric we've been seeing coming out of China and Europe as well. So sovereign emerging market credit had remained resilient, particularly African sovereign credit. And I'm now referring to the chart on the bottom left-hand side, which basically tracks performance of MB sovereign index, the iBox sovereign African sovereign index against the volatility index. And what this chart shows is that over the last couple of years, at least, the performance of these indices, emerging market and African indices, have been positive and trending in the right direction. And of course, there have been ups and downs when volatility has peaked. That you can see there have been dips in both the MB and the African sovereign index. But what was encouraging is that the African index had lower troughs and lower peaks. It was more consistent and less volatile in its appreciation over the last couple of years. This trend has been bucked, obviously, since last week. We've seen a massive sell-off in emerging market and risk assets across the board, which has resulted in a depreciation in both these indices, as you can see in the right-hand side of that on that chart. But if you zoom in and just look at what some of the main components of that African index, the chart on the top left shows how yields have moved as well across the major economies on the continent. And um, basically, since the 1st of April, before the tariffs were announced, till the 7th of April, which was on Monday, we saw a massive widening of credit spreads. So just to give you a flavor, Angola, for example, on average widened 275 to 350 basis points, Nigeria 190 basis points on average, Gabon 300 325 basis points, and then you had the likes of Rwanda 200 basis points, Ivory Coast 135 basis points, and Benin 130 basis points. So there's the differentiation between the oil or energy exporters versus the importers. You can see that the Angolas and Nigerias and Gabons have widened out significantly more than the more energy importing countries like Ivory Coast, Benin, and South Africa, for example. This widening was pared back yesterday slightly, anywhere uh, between 30 and 55, 60 basis points across the board um, on um, on possible respite from the headlines that we were seeing coming out of the trade wars. But this morning, uh, unfortunately, spreads have widened out again, given uh, the new tariffs that have come into effect, and the extra tariffs that have been imposed on China. I think it's around 104% on certain items. So it's been quite a difficult environment. I think markets are a little bit dislocated. There has been indiscriminate selling of risk assets, which has resulted in yields widening out across emerging frontier markets, but also in other parts of credit and, in fact, rates as well. Um, this obviously has been disproportionately high for emerging and frontier markets like Africa, which basically means that there are higher risk premiums implied in how the yields have moved up in the last 1 week due to the selling action of international investors.
It's
I'll pause there. I hope I haven't scared the audience too much here. But this is where we are at the moment, volatile markets. But we're hoping that calmer minds will prevail in the coming weeks and months, and we will revert back to our mean.
Yeah, I think that's a really good point in terms of the contrast of what we've seen over the last few years relative to the speed of change over the last week. Perhaps if we do take that longer term view, we'll see something slightly different to the volatility and difficult times, I think was how you phrased it. I think that would probably be a good time then to turn to Bilal, um, really around the sense of, we're in unprecedented times. Everyone's talking about this, high uncertainty that we face. If we take that in mind and we turn our attention to the white paper itself, and specifically the methodology that I know that the team adopted, the scenario-based approach, which, from my understanding, was selected to really help navigate that uncertainty and provide a longer-term view of Africa's credit outlook. Perhaps you can come in there and elaborate a little bit on that framework, and more importantly, what were some of the key insights that that framework generated when it comes to these tensions between geopolitical, domestic, and credit market factors?
Thank you, Gabby. So I think you've hit the nail on the head there in terms of why we've approached this report or the white paper using a scenario-based methodology. I mean, the volatility is quite unprecedented, and we do not want to be reactionaries and look and provide knee-jerk reactions to current developments and have a longer-term view. And we've mapped out three possible scenarios where things can pan out. So the scenario framework helps map those exposures that Faisal spoke about in practical terms, where investment is likely to land and where trade disruptions are most sensitive, but also where access to finance could narrow. And I think this is something that's quite peculiar and interesting to that a few of the findings that came out from our research. So it's not only about predicting which scenario will play out, which is usually the common assumption of what scenarios do, but also stress testing the assumptions under each of these pathways. So that gives us a clearer, a more forward-looking view of where exposure is rising, where buffers currently exist, stress testing those, and how credit conditions may evolve in the long term. Also, from a geopolitical perspective, which is something quite key here, it's becoming a more and more important dynamic to follow and to assess. African economies are now dealing with particularly a US that is less interested in multilateralism and more focused on conditional, bilateral, or if you want to call it transactional engagement. So that is already visible in the way the trade benefits are being reassessed, and as we've seen with the widespread tariff shakeup, GOA eligibility, and it's something that we've also looked at in quite a bit of detail, and also how digital infrastructure is being politicized and investment flows are being narrowed around these strategic values.
I'm actually going to bring up the AGOA beneficiaries map there. I think it would be quite interesting if you can elaborate on that. I mean, what do you envision as the next steps for regional markets, considering these recent actions that we're seeing coming out of the US? Are we very nervous around AGOA continuity?
So under our second and third scenario particularly, and also a report that we published on Pangaea Risks platform today, we believe that the prospects for renewal appear more and more limited. So a broader shift away from trade preferences suggests that AGOA may be allowed to lapse, which could likely trigger a decline in US sub-Saharan trade. And this also could accelerate Africa's trade pivot towards alternative partners such as China, the European Union, and the Middle East. Also, inter-Africa trade may see rise, where already preferential arrangements remain in place. So I think there will be a scuffle for finding these new opportunities and new trading partners or growing them. But in the absence of US incentives and industrial growth around and job creation in African economic sectors, particularly around garments, automotive industries like in Morocco, and agriculture in most of the continent, may stall or even reverse. So weakening the longer term economic ties with the US, particularly if scenario two and scenario three, those two or combination of those two manifest. However, countries, this is where the opportunity comes in, that align with Trump's critical minerals agenda, particularly by offering US firms access to strategic minerals, may be able to negotiate new bilateral deals to sustain these industries. So there's a growing policy push from within the US administration, including frameworks such as the Project 2025, that argue for reduced US engagement in multilateral funding, which is something, again, that's quite key in terms of what we've been covering and following over the past few weeks, Now the Treasury has pushed back against this full withdrawal from multilateralism and IMF programs and World Bank and so on. But even a small partial disengagement, such as delays in the IDA replenishment or blocking of IMF quota reforms, would directly affect African sovereigns that rely on timely program support to manage liquidity. So countries particularly like smaller countries such as Eswatini and Lesotho, which rely heavily on apparel exports to the US, are now at the risk of margin erosion and foreign exchange tightening if market access is reduced or priced up. Also, if you want to look quickly at the larger markets such as South Africa, Nigeria, and Kenya, the response will center on trade diplomacy specifically and how they react to these tariff policies, but also capital diversification. So several of these countries are already, as I mentioned before, recalibrating toward the Gulf or Chinese funding sources, but those alternatives bring their own conditionalities and liquidity constraints. So the next steps are not just about securing finance, which has been the crisis mode that we've seen post-COVID right up to this stage, but they're also about preserving the predictability in trade, investment, and program engagement.
Well, thank you, Bilal. I think that, there's a few interesting points that come out of that. The one is, it seems to be the impact on Africa. It has a regional spread to it. You specifically showcase Southern Africa there and how some of the impact might be more acutely felt there. But at the same time, different countries are going to have to deal with the fallout of this differently. And I think that's a nice opportunity to bring you in there, Zainab, because I know within the paper itself, you looked specifically at domestic factors, and obviously the core theme of the paper is around political change. Perhaps you can bring us a little bit closer to home then and look at some of the domestic political shifts that we've seen on the continent. Obviously, we had some key elections last year. We will be having some key elections this year as well. How has this sort of domestic political and election outcome really shaped policies around these scenarios? And then more importantly, framed sort of fiscal responsibility decisions that might need to be made?
Thank you, Gabby, and good afternoon to everyone in the audience today. In Africa, election cycles exert significant influence over sovereign credit conditions as political uncertainty and fiscal loosening around the time of elections generally weigh on investor sentiment. So, in speaking in general terms, periods leading up to elections and shortly thereafter are often marked by increased sovereign risk, particularly in countries with weak institutional frameworks or histories of contested election outcomes. Now, international creditors and bondholders typically demand higher risk premiums to offset this uncertainty, which then makes borrowing costs higher for African governments and also hinders governments' access to external funding during this time. And Gabby, if we could just show the chart of Africa and the interest rates. Yes. So this chart shows that African governments face relatively higher interest rates, with many African interest rates in double-digit territory, and this was the case before we've seen the current market shakeups that Faisal and Bilal have covered extensively. So what we might see in the current climate, amid these uncertainties that are provoked by the policies that are coming out of the US, is that there will be less room for fiscal slippages in African countries that we usually see during election periods. And with this narrowing of the financing pool for emerging market securities and African debt securities in particular, there will be further pressure on African governments to tighten public spending and also apply more comprehensive strategies when it comes to managing debt. particularly managing major external loan payments that are coming up. And I'm specifically referring to, for example, Eurobond payments that are denominated in the US dollar. And apart from a smaller financing pool, what we most likely will see is reduced export revenues that are coming into African countries, which will then impact reserve levels and also impact African governments' ability to maintain currency stability and then also fulfill debt obligations going forward. So there will be increased pressure, as I mentioned, on African governments to be more disciplined in spending, and also it will require stronger commitment to fiscal consolidation to signal to creditors that debt management will remain in check. And that they are able to continue to manage debt effectively as the markets remain volatile. Now, moving away from what we see happening now and more into the longer term and the general trends that we came across while researching for this paper. The political transitions in Africa are subject to increased to a higher perception of risk. So, although much of the election-related political risks that we see in Africa are not unique to Africa, an already high perception of risk then impacts African governments' debt management capabilities and also their ability to access credit markets.
I think it's quite clear there that we need to take both a short-term view and a long-term view here in this current climate phase. Let's shift our focus then on that longer-term view. And one of the key sort of aspects of the analysis in the report is, key to understanding the evolving credit outlook for Africa has really been this impact of political uncertainties, macroeconomic shifts, and more broadly, this changing global trade space. Now, one of the key findings has really been around that despite all these downside risks, high debt burdens, interest rate volatility, external funding constraints, many African borrowers have actually, shown to be more resilient than before. Can you maybe add a bit more color to this and what might give those African borrowers the resilience to sort of face the storm as we're currently facing?
Yeah, no, that's a good question. Look, if we evaluate the last year and a half, we've seen several African sovereign borrowers access the markets quite successfully. I mean, most recently, despite the backdrop of tariffs looming and political uncertainty in the horizon, sovereigns such as Ivory Coast, Kenya, Gabon, and Benin have all accessed the US dollar markets in 2025 for a total of slightly over $4 billion. And before that, in 2024, Angola, Nigeria, South Africa, Cameroon, Senegal, and then again, Kenya, Ivory Coast, and Benin all raised US dollar funding across private and public formats. So in total, there's been about 18 billion plus of issuance since 2024. And a lot of this issuance has been accompanied with liability management exercises or for funding, which was stated purpose of having paying off foreign currency liability. So sovereigns have been a lot more sophisticated, a lot more smarter in terms of actively managing their liability profile to ensure that their debt remains somewhat on a sustainable path and that they remain in a position to address upcoming maturity cliffs. So since 2023, the last sovereign default was at Ethiopia on the continent. on their bonds. And since then, there hasn't really been any more defaults on the continent. So I think in terms of the active debt management coupled with the positive credit fundamentals, which are long-term kind of a view on the continent, given their abundance of natural resources, human resources, and now what we are seeing, as Zainab also will allude to in a bit, more stable political transitions in key countries in Sub-Saharan Africa has allowed credit to be more resilient over the last couple of years, despite bouts of increased volatility.
Thank you. I think, very, very interesting points there. But when it comes to political stability, obviously 2024 being the biggest election year globally, and of course that impacted Africa. But 2025 having a few big elections take place on the continent. Zainab, maybe you can sort of speak there around some of the domestic political uncertainty and how that has become central to some of the discussions around market stability. Can you share some facts around how political risk factors might be being debated right now when it comes to some of the key elections on the continent? And in your view, then, how does this heightened political risk then translate into these credit outlooks, where, to Faisal's point, where we've seen sort of a more stable transition, it has benefited the outlook? What are we likely to see in 2025?
Thanks, Gabby. So what we've seen in 2024 is that there was a welcome shift from comfortable ruling parties that have been ruling for decades, more towards proactive leadership. And this was part of the electorate demanding more accountable governance and demanding more responsiveness from their government. So this was welcomed by credit markets. And although what we saw in Senegal with the audit of fiscal finances that actually revealed a higher debt to GDP ratio and also higher fiscal deficits than what was reported by the former administration, this then still points to new commitment by the new government towards transparency and towards more proactive debt management and a move away from secrecy that can then impact the government's debt position. So, like I mentioned, the initial reaction was perhaps negative, but if we look at that in the longer term, we see an improvement for Senegal in this context. And looking ahead for some of the key elections that are taking place this year, one that is particularly interesting is the election in Gabon, the presidential election that is taking place this Saturday on the 12th of April. And what we have actually seen happening is that the Gabonese military government has opted to hold elections 4 months before its transitional period officially comes to an end. And the reason why the government is doing this is because under military leadership, it has been struggling to access financing. And this has then resulted in difficulties in fulfilling the country's debt obligations. And now what the government is hoping to achieve by this election that is taking place on Saturday is that it is hoping to signal political stability to credit markets and also increased legitimacy for the current leadership. And these would be positive indicators for creditors, and it will also provide a more stable outlook rather than being under military rule. So Gabon's election, while I mentioned earlier that elections are often accompanied by fiscal loosening and perhaps uncertainty over populist policies that may impact countries' fiscal positions. What we see in Gabon is actually how an election can be positive for an African government's access to credit going forward. Now, bringing it back to the current context, Gabon is one of the African countries that will be less affected by tariffs directly. However, in saying this, with a broader financial pool of funds narrowing for emerging markets, there will be pressure on the new government that is coming in to maintain fiscal discipline and also to increase fiscal prudence, specifically as the government tries to access an IMF program to manage its debt. But in saying that, all of this points to proactive management of debt that Faisal mentioned earlier, that is positive for the credit outlook for many African countries.
I want to follow up on that. Just, you brought it back to the current climate and perhaps Zainab and then also Bilal, if you want to come in as well. With this domestic lens, then perhaps you can take us through some of the responses we're likely to see from African governments relative to the US. For example, are we anticipating further diversification of trade partners as a means to bolster resilience, for example?
Yeah, thanks, Gabby. That is, I guess, the question on everyone's minds at the moment. And we've seen mixed responses to the US policies across sub-Saharan Africa. So as of yet, there has not been a collective response from the continent. On the one hand, we see some countries initiating direct bilateral negotiations with the US, as the Trump administration clearly prefers a deal-first transactional posture when it comes to economic cooperation, and some of these countries include the Democratic Republic of Congo, which offers vast mineral reserves, and then also Madagascar. Interestingly enough, Madagascar has been hit with a 47% tariff. But it has deposits of rare earth elements, nickel, and also copper, which could be helpful for negotiations with the US. However, given that US trade with sub-Saharan Africa as a whole only makes up 1% of US trade with the world, it will be challenging for a single African country to independently negotiate deals with the US if they do not offer these critical minerals access, like what the Congo can offer, for example.
Thank you. I think, if you don't mind, Zainab, I know that the spotlight is a bit on you, but we have had a question come in through the Q&A, and I think it's a good time to just add it here because you mentioned the DRC. The question reads, how do you see regional risks from M23 and the conflict in the DRC and potential dynamics with Rwanda changing this relative to the DRC's approach?
So the DRC's current approach is actually informed by the situation that is happening with the M23 in the Eastern conflict. So what the DRC has done is that they have offered the US access to its critical mineral reserves in exchange for security support to fight the M23 in the east. And the M23 is a rebel group that has captured a large amount of territory in the eastern region, which is currently supported by Rwanda. So this has actually formed, it is actually at the basis of the DRC's negotiations with the US, and I think that the DRC is more likely to maintain this current posture, and it is unlikely to change to change in the coming weeks. It is the most likely the most favorable position that the DRC can be in for now, considering President Trump's priorities when it comes to securing critical mineral supply chains for the US, and then also the Democratic Republic of Congo's mining sector is dominated by China. So with the DRC offering for the US to come in, that then also plays to Trump's desire to reduce China's global economic dominance.
Great. Thank you. Thank you for addressing that as well. Hopefully we've answered your question. A great reminder to the audience to please pop your questions in the Q&A function. We'll be turning to the Q&A fairly shortly. I just wanted to have two follow-up questions for Faisal and Bilal. Firstly, Bilal, we've obviously looked at the scenarios. You've already pointed to scenarios 2s and 3s potentially being the trajectories of where we're headed. Faisal's also sort of spoken a bit around the underlying resilience we've seen amongst African borrowers. Perhaps are there any game changers that you could maybe upfront that might undermine this resilience or deepen this resilience? Are we concerned around the US position vis-a-vis IMF and World Bank, for instance, specifically when it comes to African borrowers?
Absolutely, Gabby. So this concern is I think well-founded. So there's especially relevant for countries already under the IMF program, such as Ghana, Kenya, Zambia, and Egypt to a certain extent. So delays in disbursement or uncertainty around governance reform timelines could affect investor perception and raise refinancing costs, which is something we allude to in our document, particularly for those dependent on external budget support or don't have sustainable access to this external support. We also flagged particularly AGOA, the expiry of AGOA as a clear catalyst. So if it ends without replacement, the loss of preferential access could raise trade exposure risks for a wide range of exporters, not just large economies, but also vulnerable states like Lesotho and Madagascar. So that compounds existing risks for commodity-linked revenue streams and could accelerate external balance pressures. So the resilience which already I think Faisal will allude to in his answer to this question is also quite real, but quite conditional. If trade arrangements become unpredictable, and we're already seeing signs of this, or if financing, both concessional and direct, weakens due to geopolitical frictions, then that resilience will likely erode very quickly, particularly in markets where fiscal buffers are already stretched.
Faisal, anything you would add to that from your perspective?
Yeah, I totally agree with Bilal. I think it's very much up to how each country on the continent responds to the challenges that are presented to them. As Anna mentioned, less than 1% of trade is with Africa. It's about how they can pivot away, how quickly they can pivot away to other sort of regions, either whether that's EU, China, UAE, or GCC. The flexibility in being able to do so will be critical. Right now, the main challenge is that markets are trading on headlines. So, Trump comes up with a statement, markets react to it. China comes up with a counter statement, markets react to it. In a particular way. A rumor flies out of the White House, and markets take a breather, and they come back for a minute, and then the trend is reversed. So it's all very headline driven, not very fundamental driven, which I think markets were after a 2-year hiatus from 2022 to 2024. Markets started becoming a little bit more discerning, and we're actually looking at credit versus just a headline risk. So I think it's going to be important for the investor sentiment to come back to that mindset of evaluating every country on its merit, every sovereign on its merit, and how it's reacting to the challenges, particular challenges that particular sort of country is facing, and obviously utilizing the tools that are available to them, whether those are fiscal buffers or other relationships that they may have with their trading partners. So yeah, I think as I mentioned, these opportunities will determine how quickly African nations are able to identify where they can plug themselves efficiently into global supply chains. So for some, an increasing engagement with the US will benefit their economies. The selected bilateral approach Bilal spoke of earlier. And for others, a pivot to Europe, China, or the Middle East could be more beneficial. And of course, political stability, continued fiscal prudence and strength, and long-term strategic utilization of resources will allow key African nations to create meaningful long-term global partnerships.
Great. Thank you. I think on that point, if the panelists are comfortable, we've got quite a few questions coming in on the Q&A. So I think it is beneficial that we turn to them. I'm going to just start with one that came in quite early on in the discussion. When we talk about US involvement, what are the incentives on offer and what strings are attached? Bilal, maybe you can come in on something like that, given you've looked specifically at the US here.
So the incentives offered would likely be political stability and continuity of established governments in the region. As we know, that a lot of countries in the region face stability issues, and particularly around unconstitutional government change. And the number of countries are already on the high risk of seeing those changes because of lack of continuity or lack of preparation for upcoming leaders. Particularly, we're talking about West Africa, and we've spoken about this in detail as well. The main incentive for engaging with the US would be providing this one, stabilizing the government, but also around counterinsurgency and security issues. And for instance, Kenya is likely to see preferential treatment given its entrenched counterterrorism liaison with the US and its growing partnerships when it comes to that, particularly in countering the Al-Shabaab insurgency in the Horn of Africa. So both political and security incentives will be one of the main ones. From the US perspective, it will be around access to critical minerals. And I think this is also a thematical area that we've been monitoring and writing on for a period of time now. So the US will likely, of course, continue to try to diversify its supply chain and access to critical minerals. So countries such as Angola, DRC, and new countries may try to leverage its access to minerals to strengthen its US bilateral partnerships.
Great. Thank you, Bilal. Hopefully that answers the question there. Faisal, I'm going to send one over to you now on Senegal. I hope that's okay. The question
Yes, absolutely.
Great. The question's been brought in. Does Senegal have enough credibility to access capital markets? Should they not have access to the IMF program, which is expected to be delayed?
Yeah, absolutely agreed with you. At the moment, just to be clear, no one, I think, has access to international debt capital markets across the continent, sub-Saharan African continent, particularly. Only two countries are trading under 10% yield, and those two are South Africa and Ivory Coast. Senegal, I completely agree with where the question is coming from. An IMF program is very necessary for Senegal to make a return to the capital markets with a degree of credibility which will be accepted by the international investor community. We know that the IMF is in dialogue with the Senegalese government, Ministry of Finance. I think they agree with the auditor report and its findings. And now it's just a matter of them getting comfort with the fact that Senegal will, in fact, be putting in the necessary steps to make sure that they come back on that sustainable fiscal track. So, in short, agreed that the IMF program, which probably I agree will not come until end of Q2, Q3, will be a prerequisite for access to the markets.
Great, thank you. We probably have time for one more audience question. So Zainab, I'm afraid it's going to come your way, if you don't mind. Could you possibly share your latest views on Zambia? I think particularly around the timeline for the finalization of debt restructuring and growth outlook. I'm going to start with you, Zainab, but Faisal, if you want to add anything there in terms of what you're seeing, please do.
Thanks, Gabby. I'll tackle this one about Zambia. So what we have seen at the beginning of the year is that Zambia was able to restructure some of its debt under the G20 common framework. So France agreed to restructure some of its debt, which but overall, I will say that it's still an extremely slow process, given that Zambia defaulted in 2020. This is 5 years on. But this is not necessarily an indication of Zambia or Zambia's ability to improve its debt fundamentals. Zambia had become a case study in a tussle between China and Western-led banks. So over the next coming months, we are more likely to see bilateral deals be negotiated under the G20 common framework. And the goal was that it would be finalized by mid-2025. But given all the shakeups that we have seen now in global markets, this will likely be pushed further out. But that is not, it is not all doom and gloom for Zambia. In recent years, there has been an influx of mining investment into the country, as I think there is an awareness among investors that the debt situation is slowly being figured out, and that there is still much potential in the country, regardless of what is happening. And the government of Hichilema maintains a pro-business, a very business-friendly stance as it stands. So the outlook for the country is that GDP will rebound this year, and this will be driven by increased mining activity and then also infrastructure investment related to the mining boom that President Hichilema is expecting in the coming years. So did not really answer that shortly, but I hope I managed to cover all of the points of the question. Faisal, I'm not sure if you'd like to add anything there.
No, I think Zambia has made some strides after a long period of uncertainty. As we all know, from 2015 to 2020 was a period of, won't they default? They defaulted in November 2020, and then there's been a prolonged sort of negotiation around with the creditors, as you've rightly mentioned, Zainab. They have restructured the Eurobonds. The Eurobonds are trading in line with their peers across the continent. So they have widened out in the last 1 week by about 180 basis points or so. And there remains the open a point of their negotiations with the commercial creditors, which is still ongoing. So I think they're making the right moves and they're going in the right direction. This current bout of volatility and move against them in the credit market is not helpful. The fact that copper has also depreciated drastically over the last few days is not helpful as well, or concerns. And of a slowdown in China and the rest of the world. So there are definitely headwinds, I think, with Zambia, but they have been tracking in the right direction in the recent past.
Great. Well, thank you both for tackling that question. What I'm going to do now is I think it probably makes sense just to bring this slide up, just so that everyone has time to scan the QR code if they do want to download the white paper itself that obviously we've been unpacking today. But more importantly, if you have any questions or if we did not get to your questions today, please do reach out to the panelists or myself. Our email addresses are on the slide for you to take down. While we sort of wrap up and come to the end of our session, firstly, big thank you to Faisal, Zainab, and Bilal for your thoughtful contributions today, but also your work on the white paper. I think it will be a very, very interesting read for our audience. What I just wanted to do to wrap up is just give you each a 1 minute sort of last shot to convey any key takeaways or final thoughts that you wanted to share with the audience based on your work on the white paper, or indeed based on developments of the last 3 days in the markets. I think I'll start with how my screen is running. So let's go Faisal, Zainab, and then Bilal. Perhaps you can wrap us out. Oh, we've got you on mute, Faisal. Someone had to do it someone had to do it.
Apologies for that. Yes, apologies for that. Yeah, so the path going forward will depend on how the trade war rhetoric can cool down and what bilateral trade agreements will look like going forward. I think for now, we believe that interest rates will remain elevated given the higher volatility and greater risk perception across the globe. And unfortunately, this will, we believe, translate to higher funding terms for emerging frontier markets for the near to medium term, with many borrowers, especially in the current environment, being locked out of the market. So, like we've discussed in this panel discussion, we do believe there's an opportunity for African borrowers to ultimately pivot to alternative funding sources in various formats to diversify their sources of funding from the current pools of liquidity available to them. So borrowers have the opportunity of prioritizing their projects, which will be important for their respective national development priorities in a much more targeted way. And whilst the bond markets, for example, may not be open for everyone all the time, there are other pools of liquidity. We believe that export credit agencies related financing, we believe, is an important and has a lot of value given the current trade dynamic we're seeing globally. So I think there will be an emphasis for every sort of export credit agency supporting country to really promote their ECA and what their contractors and what their exporters can do for their partners in other parts of the world. So I think there are opportunities going forward for select issuers and borrowers who are a little bit intelligent about how they are able to source different funding pockets over the coming years.
Great, thank you. Zainab, your final thoughts?
Yeah, so I think I'll build on that point that Faisal made about alternative pools of liquidity. And my final thought will be related to how the current global volatility could be a push factor into encouraging African governments towards enhancing economic cooperation closer to home. So I see this as perhaps growing emphasis on making the Africa Continental Free Trade Agreement work, which would open up major opportunities for intra-African trade, particularly within Africa, but then also among the various regions in Africa. So the shakeup could perhaps be a reality check. And there is a silver lining. I think that there is a lot of potential in Africa to look inward and drive more resilience from more resilience internally rather than keep on relying on external partners and then be susceptible to major shakeups. So yeah, thank you.
Great. Thank you, Zainab. And Bilal, your final thoughts or key takeaways?
Thanks, Gabby. And so I think the key takeaway from my perspective would be that the landscape on Africa, on the continent, is not of uniform deterioration or an automatic form of distress. I think also we'd like to give a more balanced view and not leave anyone with a pessimistic outlook on Africa, which is definitely not our position. So what we are seeing is instead a fragmentation and differentiated forms of access to capital and diverging risk premiums and the emergence of trade-driven hierarchies in sovereign exposure. So for some, this realignment offers a path to renewed financing and different forms of financing and diversified partnerships and better refinancing terms. For others, particularly where governance instability or opaque liabilities persist, the risks will be compounded. So at the core of our work in this paper was the recognition that we need to understand that as the understanding the risk is not about predicting collapse or overemphasizing threats. It is about mapping the exposures clearly, understanding the implications, and being equipped and providing a tool, a framework for being equipped to respond to these conditions. So yes, the external environment is shifting, and yes, there's certain assumptions about trade and finance that are being rewritten as we speak. But what this does not eliminate the opportunity part. What the scenario approach and what the white paper in general does allows us to do is identify where risk and opportunity coexist and how those intersections are likely to affect credit dynamics over the coming year. So this is not about alarming anyone. This is about more providing clarity.
Great. Well, thank you, Bilal. I don't think I could have summed up the paper any better. Thank you again to the three of you for participating in the panel. Thank you to our audience. I do hope you found this a useful session. Just to reiterate, please use that QR code, download our report. You have our contact. Please reach out if there's anything we can assist you with. And I'd like to just say thank you again to all. I hope you had a great session, and I wish you all a great day further. Thank you so much.
Thank you very much.
Thank you.
Thank you, Gabby. Bye-bye.
Bye.